Forks are in fashion today. The phenomenon has become an essential feature of the cryptocurrency world. We welcome you to the Financial Market Examiner YouTube channel where you learn about Forex, crypto, and the stock market. Most people have a vague idea of what the forks are all about and what they mean for cryptocurrency investments in the long run. So on this channel today, we'll learn about forks. So let's get right into it and get it sorted out. What is a fork? Cryptocurrency fork is an event that splits the existing software protocol into two coexisting versions. Forks may happen accidentally if two miners discover a block at the same time. Some nodes of the decentralized blockchain system register different information, resulting in two chains. Since the splitting consensus causes these forks, they can quickly identify and resort, so they do not have any destabilizing influence on the network. However, the majority of cryptocurrency forks are done on purpose. They occur when developers intentionally modify the source code to add new features, fix vulnerabilities, or change the fundamental rules of network operation. Usually, the forked code is similar to the original, but with substantial modifications which are permanent and require the network users to upgrade their software to the newest version. Sometimes intended forks create a new protocol, new digital assets, and even new community. Cryptocurrency forks happen in various forms, though regardless of their nature, they have a common parent protocol and share the transaction history before the split. Types of fork in cryptocurrency. All intentional cryptocurrency forks can be classified into two major categories: soft forks and hard forks. In essence, both hard and soft forks result from changes implemented to the source code where a new version of the protocol is created in parallel with the old one. However, the devil is in the details. So let's slice and dice it. 1. Soft fork. A soft fork is a software upgrade that can still work with older version. It's called backward compatibility, which means that users that fail to upgrade their software to the latest version won't be entirely cut off from the network. Blocks created by the latest software version will be accepted by old version nodes, but not the other way around. The newer software will reject old blocks, thus forcing users to upgrade. And this is a snowballing process, as the more miners switch to the newer version, the longer their chain becomes, encouraging the other miner to update the software and join the mainstream. A soft fork may be caused by changes that lighten the rules of block validation or implement additional functionality without affecting the network structure. So rules reducing block size from 1 MB to 500 KB will create a soft fork as they imply tighter conditions. Non-upgraded users will continue to see and recognize incoming transactions, but their blocks will be rejected by the network because they do not comply with the new block size. A soft fork is possible only if a majority of users use to upgrade to the new version to enforce new rules on the old blockchain. And this type of fork is considered to be temporary, as the chain with the biggest hashing power eventually absorbs the shorter one. Thus, if more than 50% of miners upgrade to the latest version, then the older version will become redundant and vice versa. Since both old and upgraded nodes accept new version blocks, the new version eventually wins. Investor considerations. Since soft forks do not carry the double spend risks, they are mostly dull events that go unnoticed by the crypto investment community most of the times. Merchants and users with unupgraded nodes will read and recognize both new and old version blocks, ensuring smooth network functionality. Soft fork examples. Block size limits. Initially, Bitcoin did not have a block size limit. The restriction to 1 MB was introduced through a soft fork. Pay-to-script hash. This function enabled multi-signature addresses in Bitcoin network, so enhancing the code without changing the structure. 2. Hard fork. A hard fork implies a change to a software protocol that makes older and newer versions incompatible. It means that newly generated blocks do not support old ones and vice versa. Users running old version will be completely separated from the network and won't be able to participate in validating and verifying transactions. In case of a hard fork, all users have to switch to a new version to stay in sync with the network. Otherwise, if they continue operating, they will end up with an entirely different chain and different data set registered in the ledger. Two chains can concurrently exist as long as miners are willing to support the minority offshoots. A hard fork is needed to modify structurally essential parameters or loosen the rules of block validation. Such fundamental changes can include the block size increase, the difficulty of a cryptographic puzzle, limit to additional information, and so on. So, if a block size limit is increased from 1 MB to 3 MB, then a 2 MB block will be validated by a node with the newest version of the software, as it allows the block up to 3 MB. Nodes running older version will be rejected. Furthermore, it will ignore that blocks and attach its new validation to the previous one, compliant with old rules, and eventually it will end up with two chains, one with both new and old types of blocks and the other one with only old version blocks. Hard forks can either be planned or controversial. In the first case, the update was stated in the project's roadmap since the very beginning, which means that the old community moves to the new chain while the old one is abandoned. A controversial fork happens when the community members cannot agree on fundamental issues. As a result, one group introduces significant changes to the code and thus creates a new chain with a new digital asset based on it. Investors' consideration. Hard forks are potentially messy and plagued by double spending problem. Coins spent in a new blockchain will be spent once again in an old block, as merchants and users with the old version of the software will not see the spending registered on the new chain. Even planned hard forks may lead to confusion and loss of money as due to the decentralized nature of the system, and it's challenging to get all the nodes to switch to the newer version at the same time. Example of hard forks: Ethereum's Byzantium. This is a planned hard fork that occurred on the Ethereum blockchain in October 2017, in compliance with the general upgrading plan. Monero, the coin hard forked in January 2017 to implement ring confidential transactions feature, which was supposed to improve privacy and security characteristics of a coin. Bitcoin Cash. This coin was born due to a controversial hard fork coordinated by community members that advocated block size increase from 1 MB to 8 MB. Ethereum Classic. This coin is based on the old Ethereum chain that was forked to reverse the adverse consequences of Dell Arc attack. The new chain retained the original coin Ethereum, as majority of the community members supported it. Risk and opportunities of hard forks. Both hard and soft forks are inherent part of cryptocurrency universe. They facilitate and foster industry development based on the underlying principles of decentralization and open source code. However, cryptocurrency investors and traders should understand the risks and opportunities created by this phenomenon and understand that while making investment decisions. How to take advantage of the upcoming fork. 1. Free coins. Hard forks that lead to the creation of a new digital asset are welcomed by the community because they provide free coins to balance the issuance. While the split occurs, holders of the old coin receive the same amount of new coins for free. And to benefit from a cryptocurrency hard fork, investors should keep their holdings in a digital wallet or on a crypto exchange account that supports the fork. 2. Speculating the coin price tends to go down before a hard fork, as people try to transfer their assets to a safe place to avoid risk associated with forks. However, news of an upcoming fork with airdrop may boost the prices, as traders will hold the asset to qualify for the airdrop, and once the fork is over, the hype price will retrace to initial levels, and if the majority of traders are against the fork, they will sell their free coins to buy old ones, which will put the price even higher, and those who are bold enough may attempt a speculative strategy, buying ahead of the fork with the aim to sell afterwards or right before the split. 3. Crypto futures. Some exchanges allow people to buy a new coin ahead of the fork via futures. If you believe that the new asset will have value and its price will grow after the release, then go ahead and get it cheap. How to survive a fork without losses. 1. No transactions. Keep from making trades with coins that are being forked. When two different chains exist, one will eventually be proved invalid, which means that coins found on the wrong chain will be lost. Forks are very painful for merchants that work with the coin in question due to the same reason. It means that business may stop accepting the cryptocurrency until the situation clears out. 2. Find safe haven forks are often associated with high volatility. The markets may be wild and unpredictable, especially in case of a contentious fork with a lot of contradictions between the split community. And if the conflict escalates, prices may fall really hard. So make sure that your crypto portfolio is well diversified and try to keep the amount of fork coin at a minimum unless the dust settles. 3. Wallets care move the coins with the upcoming fork to a private wallet, or make sure that your exchange promise to support the new coin. Also, be careful downloading a new wallet for a forked coin until you're sure that it's not a malware, and don't trust your asset to it before it's thoroughly checked and tested. A fork is a stressful and nervous event for a cryptocurrency community, often associated with losses and increased risk. But due diligence and common sense will help to pass through the tough times unscratched and even reap additional benefits. Do share with us your feedback on this video in the comment section, and if you have any topic you want us to talk about, kindly share with us. With this, we've come to the end of the video for today. Please remember that this video is not for financial advice, but for educational purposes only. Kindly subscribe, share and like after watching. Thank you.